So hello everyone. So this afternoon session, welcome everyone here in this room. We have this nice title of breeding unicorns. Maybe we start first with a little intro so that you get a little bit more what we are and what we do, and then we dig into this interesting topic of breeding. Okay, Jenny, you want to start? Quick
Sure.
intro?
Hi everyone, I'm Jenny Fielding, and I'm co-founder of Everywhere Ventures. We're a pre-seed fund that invests everywhere. So we believe innovation is everywhere and we want to be where founders are. We've invested in 250 companies. I'm based in New York City, but we have a global portfolio.
Continue.
Hi everyone, Michael Sidgmore, partner and co-founder at Broadhaven Ventures. We're global early stage fintech investors. We're built on top of merchant bank, so market leading fintech investment bank that's done close to 90 billion of M&A transaction volume. So we leverage the bank to help our early stage fintech companies around the world, mainly pre-seed, seed, and A. And then we also invest in funds as well as incubate businesses in the asset management space.
Great. Chris?
And I'm Chris Thomas. I'm a co-founder and partner with Assembly Ventures, the first transatlantic mobility fund in the world. So our team sits across Detroit, Berlin, and Silicon Valley. We invest uniquely in air, land, sea, and space companies across global mobility constructs, but in the Western world. So we have companies that go across energy storage and battery production, real-time payment in any automotive environment, looking at different opportunities for circular economy and recycling for materials, and real-time ways in which you can do fintech as it relates to mobility benefits going to employees throughout Europe. But I'm based in Detroit. It's a pleasure to be here.
Thank you. I'm Christian. I'm partner with Early Bird Venture Capital. As the name indicates, we invest in early stage. We do the first institutional check, 5 to 10 million, in sectors like fintech is a very, very big one with us, fintech and insurtech. The second one is enterprise productivity. And the third one is deep tech. And within deep tech, we do food tech, we do energy and space. So now, and all of us, I think we have some unicorns in the portfolio. Maybe, Jenny, we start with you. You have basically a large portfolio, a huge community around the globe. What's your take on breeding unicorns? How do you breed unicorns? How is this happening?
So we're quite early. We're almost like angels. Most of the rounds that we invest in are, less than $1 million. So we can act as that real kind of, formative believer in the company. And what that means is that we like to buy up ownership early and get in at attractive valuations. So when we invest, we're investing in companies really under a $10 million valuation. In the US, that's quite reasonable. Maybe other places that's higher. But that's all to say that we're looking for kind of scrappy founders that don't need to raise millions of dollars, that don't need to kind of have inflated valuations at that early stage. And we think that's a great recipe for success for unicorns. And actually, we have the first one in our portfolio. And really, if you think of what that means is we have a good friend who wrote an article about instead of the unicorn, the camel, right? And so what are the attributes of the camel? Doesn't need a lot of water, can be, energy or in this case, capital efficient. And so we love companies that are really thinking about, unit economics first, real kind of fundamentals. And I think that carries through to building unicorns as opposed to what we've seen in 2020, 2021, which was exuberance and excess and really high growth. I think you can have kind of slow and steady can actually win the race.
And do you think this will stay, or will we get back to this kind of hype phase, basically, where everything becomes a unicorn in the end, so kind of quote in quotes? Is this something to stay now where we are, or do you think this will change again?
I've been investing almost for the last decade, so I have seen a few cycles. But, again, we don't really care how the market shifts. Again, we're looking for those capital efficient businesses. And quite frankly, it was hard for us in 2020 and 2021 because our model didn't fit most companies. And we just, put our heads down and said, we're going to find, those camel unicorns instead. And we were able to. So, whether things will change, I'm sure they will. Investors, venture capital investors are sometimes short term, right? We forget those cycles, but it's just not in our DNA. We're all founders, so our model is that our fund is we have 500 founder and operator LPs, and so people around the table are all people that have built businesses, and for the most part, they've built them in good and bad times where they've had to be kind of scrappy. So.
Okay. Chris, you have a very dedicated focus on mobility. is this the key basically to build unicorns? Do you think you have to be very focused on something? Is this what matters most, or what is it from?
I think it is. And if I didn't think that, then I'd be in big trouble, given where I'm investing. But I do think that the future of venture is very much sector focused. I think what you want to have and what entrepreneurs want to have are individuals that bring more than capital. They bring expertise as it relates to differentiated parts of their business. And yes, it's great to make sure that you're having just sound judgment at a board level, but you also want to have just great networks and partnerships you can tap into to make sure that's a core component of what you're doing. But for us, when we think about global mobility, I'm betting that this sector broadly will be one of, if not the most important sector of my lifetime. And we define mobility a little differently than most. You might think of it as kind of the movement of people, the movement of goods. We define it as the movement of goods, data, energy, and people, and the ways in which we're going to be looking at the intersections of all aspects of movement. So as I mentioned, some of the profiles of the companies we've invested in earlier, it's logistics, it's manufacturing, it's automotive, it's maritime, it's aerospace, it's space. And I think if you're really focused on, and I loved your answers around entrepreneurs, if you're just focused on high integrity individuals, if you just focus on the teams that you're investing in, that's where you're going to find, I think, the best outcomes. And we've been very lucky with our first investment. We did that at a $45 million pre in September of 21. We just closed a $300 million Series B at a $1.2 billion post. And so having that type of growth is directly a result of the amazing team that is a part of that company.
How would you respond to the point that, and we asked this question in terms of specialization or being a little more broadly, with regard to portfolio approach, because in the end you're betting on a sector, you're betting on a certain trend, but you don't know whether this will hold for the 10 years basically in which you should create your returns. How would you see this, or do you adjust basically the focus areas according to the trends or the things which are hot? Because obviously if you allocate the money into a wrong sector, being very narrow, you can basically be totally wrong, because this becomes totally out of fashion at the time where you would like to exit. The multiples are not there because they have been gone down. I
mean, I think it's a fair point, but the way that I always respond to that is like, I know that I'm very good at a handful of things. If you ask my wife, she would say a couple less. I'm very bad at everything else. And so I want to make sure that I'm being very focused and bringing value to what I have. I'm building an amazing team around me to do that. And I'm indexing a sector. Now, mind you, we're looking at it broadly. We're looking at a big funnel. So if you're a generalist investor and you're indexing a sector that you believe has huge macroeconomic or just TAM growth characteristics, that I can get behind. But if you are just a tech investor, if you're just a healthcare investor, I don't know why, as an LP, I would choose to entrust capital there as opposed to going into an index fund or going to places that, to your point, are truly spreading risk. What is the differentiation of that buy-side manager, unless you're a Chris Sacca? That's going to bring something really, really unique. And I think it's that differentiation that both will provide a thesis on which to raise capital, but also a really principled way in which you're deploying it.
Mm-hmm. Yeah, thank you. Michael, to you, same question a little bit to you, because you have the focus on fintech very much. Same question in terms of how do you see this basically one sector approach vis-a-vis a little bit broader approach, and what's your take on basically breeding the unicorns? How do you breed fintech unicorns?
Yeah, we have done that. I have, I think, 3 different perspectives. So one is I built the sales team pre-product at a business that is now a unicorn, and a very efficient one, a company called iCapital, about 153 billion of assets, kind of the rails for enabling the high net worth channel to invest into private markets, so really alternative investment funds. So I've seen it from that perspective, and I think from the company building perspective, where I no longer am, but still close to the business, is that they've found a way to get to a very sustainable place as a business, and I think investors will prize that. So talking about kind of how should we think about unicorns, or I like to think kind of $100 million revenue plus businesses, if you think about, obviously more relevant to SaaS most likely, but you can kind of take a 10x revenue multiple and say $100 million plus revenue business with a pretty sustainable, sticky revenue base. Should 10x or so, obviously in the 21 time frame, it got a little bit out of hand. I think it was around 30,
100x?
Yeah, 80x, 100x. I think the average was like 34x on a SaaS multiple. That's obviously gapped down to 7 to 12 or so, maybe 15 for a really good business. But I think from that perspective, like the key is how do you build a really sustainable, efficient business maybe, I mean, not all businesses will be as efficient as Jenny's businesses that are incredibly capital efficient, but I think both investors and founders should strive for that to be the case. So from that perspective, I've seen that from the building side. We had to raise capital, and we had a consortium of investors at iCapital that were banks, so we got strategics involved. It was a very different way of doing things, and we had a roll-up strategy as well, where we bought bank feeder fund platforms and got a lot of assets and customers. So that was unique, but I think they figured out a way to become sustainable, and I think that from the company building side, I've seen it that way. As an investor, and then we invest in funds, have seen it from those lenses as well. As an investor, I do believe that sector-focused managers make a lot of sense because they have specialization and can really understand a space very well. We do take a broad view of fintech like you do, Chris, in a sense in mobility. So we do believe many companies can embed financial services, and I think that will expand their TAMs, and that will expand their customer bases, expand LTV in certain cases, and also increase retention. We have a company where I led the seed, a company called Nowports, to digital freight forward in Latin America. They are now a unicorn. They started out doing freight forwarding, so tracking the shipment of cargo, mainly maritime cargo, from point A to point B. But then they've since embedded financial services like lending, like insurance. And I think that's where they've been able to expand their business, expand the customer base. So I think we are sector focused, but we see that there's ways to think about and embed fintech into other ways. So from that perspective, I think there's that view. And then from the fund perspective, we've invested in 18 managers, mainly emerging managers, sub-$100 million funds. And I think when we look at those managers, whether it's Goodwater in consumer tech or Lower Carbon in climate, I think they're very specific as to what they do, and they have a differentiation, and I think founders see that, and then they're able to attract founders, or they're able to discern which founders can build really big, sustainable businesses. So I think from both those perspectives, I would argue that the sector-focused approach tends to create, with the right ingredients, and we have our investment bank that helps us help companies all the way from seed to exit, or even smaller exits sometimes. So I think that sector-focused approach really can help.
Mm-hmm. So we see that basically there are many approaches here to come to unicorns. Let's try to maybe double-click a little bit on this here. McKinsey tries to analyze what are the ingredients basically for building unicorns, and they say it's a five T model. They say it's the team, it's the TAM, so the total available market, it's the tech, it's the traction, and what was the fifth one? It was timing. So those five. Can you elaborate on those in terms of what's it take, make a little bit more specific? So, if probably a few founders are here, so what do I need to do basically to create a unicorn? Because I think we have all the same interest. We are the VCs, we want unicorns. If you have a unicorn or two in your portfolio, you're probably yielding good returns. If you're early stage investor, that's important, not basically collecting unicorns at a late stage. That doesn't bring you to this. But if you are, and obviously you as founders want to achieve the same. So what's your take on those 5T? Do you think they hold true? Or can we try to basically double-click in that respect, that we make it a little bit more concrete so that people know, and you guys know, what to do basically to get to this status of a unicorn?
I'll start with team, and I'll have these guys can take some of the other T's. Again, as the earliest stage investor on the cap table, we don't have much data, we don't have a lot of metrics, and so we have to really focus on the individuals. And although there are a lot of different characteristics that we look for, resilience, et cetera, I'd say I have 4 or 5 unicorns in my portfolio where I was their first investor, and they share one thing. And that is that the team had an insight or a vision of a future that didn't exist. And they saw something that I couldn't see, that most people couldn't see. And in all cases, it was actually quite hard to get the first round of funding. So I saw a spark in these founders, but other people didn't see it. And so I think that that characteristic of being able to see the future and single-handedly be so focused on it that you block out all the noise of, oh, maybe you should do this, or here's a short-term opportunity, but they just kept on going even when the world told them no. And so I really focus on team and those kind of visionary founders, within that. So
maybe let's stay a little bit with teams, because teams is named number one, and we also believe that it's really about teams, especially if you invest early. So because then nothing is there, just the team. what does it really take, so to make it a little bit more clear for the audience also? So what do we really would like to see when investing, expecting that you expect every investment basically having the potential to become a unicorn, at least what we do in the end. We don't, because we don't know in the beginning, nobody knows. So you do the investment, and at least we have the aspiration, or at least the benchmark in terms of every investment we do should have the potential to become a unicorn. Probably you share that view. How do you basically in the very beginning get to the find out whether the team ticks this box in terms of, okay, this team is checkmarked, we believe they can or have the potential to get there?
Yeah, well, for us, a lot of it comes down to our top of the funnel and how we're sourcing. So we're a community of 500 founders and operators, and all of our deal flow is coming from one of those people. So as we're looking at teams, they're not super random. They're coming from people that are, vouching for them in some way or another, right? Saying, oh, Jenny, I get this call probably once a week. My product manager is leaving and is starting this company, and this is why she's been so incredible, right? So already our funnel is, someone that we trust, someone that's given us money, who's also a founder, is saying, like, here's someone that you should kind of pay attention to. And then I'd say the other thing is, and why I'm somewhat grateful for this market is we just spend time with them, right? And we get to know them. And in the last few years, that's been more difficult because rounds were just happening so quickly, even at the pre-seed. And now the way that we're able to kind of determine it is really just spending time with them and to see, do they have that resilience that we're looking for, kind of kick the tires on that. This is what I've been saying recently to founders, which sometimes shocks them, where I say, all right, we're going to help you get this $1 million round together. What's going to happen if this is the last capital that you ever raise? And you can see the founders that are shocked because they want to be on the venture capital treadmill, and the founders that are like, oh, wow, yeah, we already have a plan for that. And it doesn't mean they're less ambitious or don't want to raise or whatnot. So, we try to spend time with the founders and really kind of understand their personas.
Yeah. Something to add from you with regard to?
I think two things. We also invest generally very early, so pre-seed and seed in the majority. So I think team does matter most, right? I think two things there. One is founder market fit. So I think, does the founder have a reason to be building this business? Kind of like you said. I think we've seen that when there's a reason why they're building this business, or they have a background. I think in certain areas, like we do fintech, so I think certain areas of B2B fintech, like private markets, alternative investing, we have a number of founders who are older. They came from industry. I think that type of thing in certain areas of certain industries, particularly fintech, ends up being really important because they know the players, they know what it takes, and they can navigate incumbents as well as find the right customers and partners and navigate those, in many cases, longer sales cycles. So I think founder market fit's really important for us. That's been the case in other parts of our portfolio. And then I think the other thing is the slope of the growth rate from at every stage. So how fast is the founder growing, and how fast are they iterating on things in terms of understanding what they're doing, how they're doing it, response time, cycle time in terms of getting decisions made. And I think when you see that very early on, you start to get really excited. And in a lot of our best companies, we saw that very early on. I think something slightly different in terms of a take is that TAM doesn't necessarily matter. Carta is an example in our portfolio. We were Series A investors in Carta. A lot of people thought Carta was way too small of a market. And I think that was one that seemed non-obvious, but Henry had a very specific vision. He also believed in the atomic unit of value and could clearly kind of map out what private markets could look like in his mind, and was able to roll out the string in ways that I think many other people didn't see. So I think you can find great founders in smaller markets to start, provided they have a lot of the qualities that we're discussing.
Yeah.
And I would just
With
say,
regard to team, any additions from?
I think the comment's been made really well. I would just say three things quickly. One, I think one T that's missing is tenacity. I think you just need entrepreneurs who refuse to fail. Some will fail, but this belief in yourself and what you're building and continue to go forward. I think the comment around the venture capital treadmill, for all the entrepreneurs in the crowd, if you're ever asked how much money do you want to raise from VCs, your answer should be zero. And the reason, and I say this as a VC, we are here to be great partners and to help you, but every time you trade capital for equity, you're losing more equity in the business that you are pouring yourself into to build. And so you don't want to take capital unless they're going to bring capital that you need and other attributes that are going to benefit you, and they're truly good partners going forward. And the only last comment I'd make is I think we talked about our friends at McKinsey. I was on a panel in Tel Aviv 2 weeks ago in which the gentleman next to me was talking about how we will be completely EV by 2040, which is complete and utter nonsense. We are going to have global powertrains of traditional ICE, EV, hydrogen, fuel cell, and other aspects for the rest of the time that all of us in this room are alive. So be careful when you're getting reports from men that are far away from the battlefield. Talk to the entrepreneurs and the people that are actually doing this in the fight every day, and you're going to have much better data on which to build your businesses, and we have much better data on who we want to invest in and why.
Thank you. Maybe let's go to markets, because I agree with you. These markets which are not in existence, which are basically only come into life, basically, or come to existence with a product, with an approach. Those are also we like very much in the end, where you can't calculate a TAM, which is maybe very small at the beginning. Like if you think back, mobile is the best example. Obviously, there was no market for mobile. There was no market for apps before the iPhone came. So this kind of notion is, I think, this is very, very interesting. Basically, where you can analyze almost nothing. You can say, okay, how many users are there? So this kind of thing. So this is probably also what you meant in terms of, well, there's no market as of today. You can't make the math. You can analyze something, but the application can basically open a market.
Yeah, absolutely. I think, Carta is a great example of it. Unlocked all these other products that you could build for venture funds. Started with founders, but then you could go to venture funds, and you could do fund admin, and you can do a secondary market. I think a lot of entrepreneurs in that space, we spend a lot of time there, so we're seeing that. Bunch is another good example of that in Europe and in your city, Berlin, where they're really trying to roll out the string on, you can start with one thing, an SPV product, that could be for founders, that could be for funds, that could be for angels, but then you can serve each of those customers in so many different ways, so you can kind of you start very narrow, but then you can like create a reverse funnel almost, and capture so many more people in a wider net, but that it's hard to find. I mean, I guess, do you think about TAM at early stage when you're investing? Because you invest early stage as well, right?
Yeah. Again, to this point, sometimes there is a market, obviously, and the question is how fast is this be growing? It may be small, but can be growing to a certain size. In the end, we all want markets which are 10 billion plus, I would say. At least we see it like this. They can be in existence as of today and growing nicely, then that's good. But they also can be not in existence, and we need to basically try to get our arms around, okay, how many users how many people will be using this, how many people in a corporate will basically signing up to a SaaS tool, and so in this kind of way we try to figure out. But as of now, there is no market. So, but that doesn't matter in the end.
That's why for all the founders out there, if at the early stage, at the seed, if an investor passes because of TAM, either you didn't describe the larger vision, right, the kind of ancillary areas that you can go into, or they're just not the right investor for you. So it's a polite way of passing, so keep that tip in mind.
It brings up one interesting intellectual point, though, that I think we can probably all comment on, which is fund sizes have gotten bigger for the most part. And yet, I think we moved on from the 2021 time period where I think a lot of people were thinking, oh, there's going to be a lot of $5 billion, $10 billion outcomes. Now I think $1 billion outcomes would be great again, right? And that seems more reasonable, but yet fund sizes are bigger. So I don't know the answer to this, but the intellectual question is, if fund sizes are bigger and investors have to deploy more capital, need larger outcomes, will they get those types of outcomes?
We just need to basically lower valuations, and then we have higher stakeholders.
So the founders in the room, I guess, are going to hear that?
Which nobody wants to hear, but...
And that's,
there is a school of thought that many of these funds are going to be giving back some of the capital, so and downsizing. So I think it's a good point.
And that's good for entrepreneurs. It's good for you in the crowd as to people chasing your deals and having more activity around. But again, think really carefully about who you're bringing in as investors, because these are individuals who you're going to be with for 5, for 7, for 10 years, and you just want to make sure there's alignment to the extent that you can judge it. Because just like we're judging you, you should be judging us and thinking about how can we build a really strong team and investors as an extension of your team.
Maybe touching upon the next tech. So how important, or what would you consider basically as a good tech for making investment decisions? What would you require in terms of basically disruptiveness, in terms of uniqueness, and how would you see this?
So the business I talked about earlier, Our Next Energy, this is a company that is looking at the domestic manufacturing of battery packs and cells, and also looking at energy storage opportunities with a novel chemistry. And it's been very common over the last couple of decades looking at nickel, cobalt, magnesium, to that be the core chemistry, but those inputs are problematic for many reasons. One, in terms of domestic supply or supply within allied nations globally. Two, a large minority of cobalt is mined by children in the Congo, which is not acceptable. And three, how do we think about ensuring that we can do these on our own continents in Europe and the Americas, not dependent upon other actors that may not have our interests at heart? And so this business was looking at LFP, lithium, as a core underlying chemistry, but they were also looking at a really audacious goal in terms of building, a 20 gigawatt, not at the time it wasn't 20 gigawatt, but a new factory in the North American market to supply North America. This was pre-IRA. This was pre there being any type of industrial policy from the U.S. government as to why this makes sense. But it was this, to your point, it was this goal that no one else saw. Like, why are we the only mobility fund in this deal alongside BMW, alongside Breakthrough? It doesn't make sense, but it's because it was so novel and it made people uncomfortable because it hadn't been done before. And I think what you've seen now is that that company has been able to ride the wave of incredible disruptive tech that they identified and we had the privilege of agreeing with was needed. And I think it's not necessarily like a novel approach to a SaaS platform, although those are excellent and huge returners, but it's this, in our opinion, this combination of software and hardware, which is very novel, incredibly strong IP or an IP-focused plan, in ways in which we can leverage that into new product sets. Those are some examples of what we look for and what came together in that one deal.
Yeah, and those sectors, I think, where it's about hardware or it's about biotech or about chemical materials and so on, I think it matters somehow to have protected IP.
It does.
But in SaaS business models, which venture mostly invests into in the end, how do you see basically the tech, and how do you measure also how differentiated tech is, or basically, or how unique it is?
You want to start?
Sure. So I'll focus on financial services. So I think in B2B fintech, the answer in some cases, although I think this is going to evolve a bit more over time, but it's that it needs to be good enough and better than what there was before. If you think about it, right, a lot of incumbents have owned or run technology solutions for a number of years. And I think while it certainly needs to be, it should be better, I don't think it needs to be at the same threshold that consumer tech, and even just consumer fintech, to take a specific vertical, needs to be better in terms of a product experience, right? The end consumer, particularly a younger person, wants to be delighted. Something like retail brokerage, right? That's a very different story. But then even you see, I mean, when Robinhood was having its challenges, there were a lot of younger people who were going to Schwab and Fidelity. And I wouldn't necessarily argue that they had better tech. So that's where I think in many corners of fintech, not to say that people shouldn't be striving for the best experience, but it needs to be better than what there was before. And sometimes that's good enough. I think we've seen that in some cases, and it still worked because they've had, I think, either great relationships in the B2B side with financial institutions, or they've had some sort of structural advantage as a business that's enabled them to still win, even if it wasn't the best quality consumer-like tech experience, but just better than what came before.
Okay. Talking about the next one is basically traction. So how do you see traction? What kind of traction do you want to see basically? Is there something where you can see, well, it needs to double, triple, whatever? Do you see something? Because, well, sometimes you are that early that there's nothing, no traction, especially in tech companies, there may be nothing because they still need to continue to develop. But if it's a SaaS business model, if they are already at MVP stage or later, then you want to see something, or there is something. How do you, or what would you require in terms of traction
Yeah, so we don't love to use that word because it implies some type of metrics or revenue or things of that, and we're always investing before that. Mm-hmm. But Michael used a term, like I think you said fast founder, and that's actually what we're looking for. We're looking for founders that are iterating on whatever their KPIs are quickly. And so, you can see that in different ways. So what we call it is momentum, right? Is there momentum in the business? That can be that they just hired this incredible person out of Google, right? It could be their hiring momentum. It can be, the wait list that they're building. It can be their product, their tech, their And so we love to see that momentum where the founder is emailing us once a week being like, oh, I just closed another this, or I just got another investor. Things are moving forward without, waiting for us to come in. So that's really what we're looking for more than traditional traction.
I think one aside I would make is that we want to see traction and growth. We want to see that, whatever KPI you're looking at, and we want it to be credible growth that you predicted. And what I mean by that is, like, when you guys put together your annual budgets, what you don't want to be on a quarterly basis is coming back to your board, coming back to your investors and say, I know we held up that we were going to get here, but we only got here. And there's all these reasons why. Set yourself up for success, not by sandbagging, but under-promising and over-delivering. And one business in our portfolio, we had a strong belief that they would be viral by way of customer acquisition in the fintech kind of space of automotive payments. So top-of-wallet payments that anyone will make around a vehicle. This was a company that in early 2001 had 40,000 users in the U.S. As of last month, had 3.4 million. Almost 2% of the U.S. driving population out of Los Angeles and Nashville. How in the world had they been able to grow so virally? It's because of an amazing experience in an environment where technology is not valued to the extent it should have been, i.e. parking in the North American market. So this is another example of where we've just seen incredible growth based on a really wonderful team that sits between the old and the new world, but has always hit their marks or come very close and continue to achieve. So there wasn't a lot of questions or time wasted on why didn't you do what you said we were going to do.
Thank you. I think we have to wrap it up now. I think we missed the timing part of this, but I think time is anyway hard to time. But we are out of time now. But I think these four are really matter most. I would say these 4 T. Timing, you can't time these things in the end. If the markets are ripe, the markets are ripe, but you can't time these. So these four are important. So thank you very much for my colleagues here for contributing, and I think up for the next. Thank you for listening.
Thank you.
Thank you.